Welcome back. Our Alpha Manager of the Day is with us, Dinshaw, Irani, CEO of Helios Mutual Fund. And Dinshaw, it's always a pleasure talking after exactly a month. Appreciate your time here. Polling has started. We are truly in the election season now. Of course, it's a long one this time. Results only by June. Last time we spoke, Dinshaw, you were of the view that it's going to be volatile, it's going to be choppy, not easy, not one way. You were talking about earnings, interest rates. Some of these things have only been reinforced, especially that interest rate bit that maybe, over the last 1 month, the view has become that maybe no rate cuts this year. Maybe one, if at best. Just reinforced some of that stuff. How has your view evolved since the last time we spoke, Dinshaw? What are you watching? What's top of mind?
So, Prashant, first of all, thank you for having me on your show, and a very good afternoon to you and your viewers. So our views remains the same, Prashant. I think that volatility, if anything, has shown up quite a bit in the last 1 month. We expect the same to continue, at least till the time I think the election and the budget season is over. Only then one can take a fresh view of what's going to happen going forward. Having said that, interest rates, as we were pointing out, I mean, not only last month, in fact, we've been talking about this for a while, that we don't expect the cuts in interest rates to be so easily implemented by the Fed, given the fact that the service inflation is a problem being faced in the US, which is a localized inflation. I mean, earlier, the commodity inflation, they could have very well fought it because of the arbitrage of dollar vis-a-vis the other currencies. But the problem with service inflation is that you're buying services in dollars and for services that are being offered in dollars. So there's no arbitrage here. So that is where our concern was. And I think that's what panning out to an extent. So interest rates, as you rightly mentioned, the view now forming is that probably one cut, that to the end of the year. So that continues to be the same. Plus, we had also highlighted the recent quarter, I mean, the March quarter, the earnings, bulk of the earnings are yet to be out. But our feel is that it will be a fairly disappointing quarter, given that the earlier 6 quarters just saw the re-ratings happening in the earnings as such. We don't see that happening in this quarter, at least. Whatever little results have come out, only the big caps have come out with results just now, but we're still awaiting the small caps and mid caps. I think that's where the disappointment will lie, because you'll see some kind of, disappointments in the results there. And that may just lead to some kind of a volatility in the market, given that valuations per se cannot be the only reason for correction. You need some negative triggers for them to work out. I think that's where it's awaited. So maybe this is the time to be a bit more careful, a bit more select in what you want to buy and stick to your fundamentally sound names. Obviously, the ones which look stretched, not only on valuations, but also on growth. I think those are the stocks that you need to move out of. So that is where I'll leave it.
Dinshaw, I remember HDFC Bank has been one of your preferred stocks. And after the big fall that we had after the Q3 numbers, you had said that I think you all were buyers in HDFC Bank after, in the correction that ensued. How have you read the Q4 numbers? And now it appears that the bank is prioritizing profitability over growth. So loan growth estimates have been brought down for HDFC Bank for the coming 2 years. Does that mean the stock goes into a bit of a range? Is it sideways? Your own expectation on how HDFC Bank will perform?
So, okay, what was the concern about HDFC Bank earlier? The concern was that they're not able to garner enough deposits to take care of the loan growths and stuff like that. Obviously, then the question was that if they are able to garner those deposits, will that come at a very tough pricing or something? One saw that in this quarter. I think they answered quite well. I mean, the loan growths were, rather the deposit growth was excellent, came via CASA rather. And as a result, the NIM was also improved quarter on quarter, and sequentially rather. So that is one thing that stands out about a strong franchise, that once that machinery starts going, there's no stopping out. And that's what I think our comfort level is out here. Even after that, you saw that the credit deposit ratios have come down, the LDRs have come down, and obviously the liquidity ratios have improved quite appreciably as such. So it's obvious that there's enough and more left in HDFC Bank to grow if they want to, right? But I think they're being very very careful in the growth because, as I said, that looking at the volatility, obviously they'll also look at the asset quality and probably work it out there. But our feel is that if the banking sector is to grow, this will be one of the leaders in the pack as such, and that's why we continue to be quite comfortable with the name. In fact, if anything, we've added to that name on every other correction that we've seen as such. So.
Okay, all right. Hi, Dinshaw. Good afternoon and good to see you. When the bank itself will be in a bit of a conundrum, right? Whether to chase growth or focus on the profitability. I think for the time being, the street would like what they said in the past con call, right? May not be very aggressive on growth, but focus on return ratios, focus on profitability and on NIMs. And I guess that's why maybe in the near term, the stock has made a bit of a bottom. Dinshaw, I wanted to ask you about the tech pack. Reema has been running us through the numbers of the last few days. And there are a lot of parameters that we're looking at now. Some of them are meeting estimates, some of them are beating on margins, but like persistent system, the numbers look good. The problem is the street was pricing in some improvement in the coming fiscal, which is unlikely to come about now. And valuation-wise as well, it's fairly expensive. How are you all positioned on IT? If I recall correctly, you all weren't very positive on the tech space.
Yeah, Nigel, you're correct. Basically, we've been fairly cautious on that space. In fact, we've been probably zero for a good part of over a year as such now on IT. And I don't think we're having a problem feeling that we're missing out something or something. But the fact is that I don't think that sector still has come out of the doldrums that is going through today. So what's the basic raw material for IT companies? It's manpower, right? I mean, the biggest indicator that they're giving you, I mean, the two largest players have seen a depletion in the manpower strength. I mean, this is the first time I believe that there's been a yearly fall in the manpower since the time probably a TCS listed or for a very long time that I remember in Infosys as such. So it's obvious that they're also seeing some kind of a turmoil going forward as such. And secondly, I mean, the soundbites that came out on the calls also, discretionary spends continue to lag. There's no big contracts coming on discretionary side. The bigger contracts are only for cost takeouts and stuff like that. The smaller contracts have literally vanished from the table as such. There's consolidation of vendors going on and all. So these are not good sound bites that comes out of a healthy industry, right? And frankly, I mean, the biggest, I think the upside that everybody was playing for was probably interest rate cuts going into the future, and that may see the industry getting revived and stuff like that. That also is not panning out. So we'd rather be cautious and be on the sidelines of the sector than try to get into something where you haven't seen any valuation corrections happening. The prices have corrected, but the fact is the earnings also have got chopped off. So as a result, you are seeing the valuations remain more or less the same as what they were earlier. And as I stated earlier, the small caps and mid caps need some kind of a negative trigger for the valuations to correct. And you've seen that in the case in one of the IT names that you just mentioned as such. Everything was fine, just that the commentary wasn't that great, and you saw what's happening to that particular stock as such.
You got that and fair points, Dinshaw. Zomato, you own it. It's one of your top holdings and is doing well. Small price increases is what they're taking, right? It's and when you look back and you kind of wonder, it could have been done, right? I mean, they've had a dominant position for a while. I mean, it's a duopoly basically. So in that sense, they have half the market. And if you believe recent reports, etc., because the other player is unlisted, Zomato has been gaining share. So the pricing power was almost there. They're exercising it now. Just your thoughts, Dinshaw.
So Prashant, actually that's what we were also bullish about. The fact that they can, they could easily increase a few rupees here and there, and then huge amount of revenue flows happening in the bottom line as such. But the fact was that like the competition was unlisted, privately funded, but of late it has gone through a lot of crunch, and the PE players in that particular company are also insisting that we need a path to profitability. So that I think gave a lot of breather space for the Zomato to realize that, okay, now I can do this changes in pricing and probably the competition will follow as such. And I think that's what's happening. Even in the hyper-local delivery segment that they have, the Blinkit, in Blinkit itself, they've seen that, right? I mean, they've increased prices and rather they've taken up subscriber prices and stuff like that. And the competition has followed soon. So I think that's what's happening out here. And that is a healthy sign also, because you're looking at now rapid growth in profits for the listed and for Zomato per se. And look at the base. I mean, we're talking about a huge base out here. The regular internet user base that is there is a potential customer base for Zomato, and they only have 2 crore regular users as such, and I think that can only grow from here. So potential is huge. Valuations are not looking that stretch if you look at a longer term basis. So we're quite gung-ho out here.
You know, there was one analysis, I think Karan Taurani said that Zomato is estimated to do about 85 to 90 crore orders annually. So a 1 rupee increase in the convenience fee will have a positive EBITDA impact of 85 to 90 crore, which is approximately a 5% increase on their EBITDA. And platform fee is one of the 3 ways in which Zomato earns money. One of them is ad revenue, and the second one is commission from restaurants, and platform fee is the third one, and they've clearly flexed that lever. Thank you very much, Dinshaw, for joining in. That stock is up close to about 2%. We will slip into a break on that note. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls from our technical experts.